Welcome to EnrichMinds.com and our session on understanding the last of the three financial statements, the cash flow statement. In this session, we shall learn all about cash flow statements and why we need them. Cash flow statements are one of the three fundamental financial statements financial leaders use. Along with income statements and balance sheets, cash flow statements provide crucial financial data that informs organizational decision-making. While all three are important to the assessment of a company's finances, some business leaders might argue cash flow statements are the most important. Business owners, managers, and company stakeholders use cash flow statements to better understand their company's value and overall health, and to guide financial decision-making. Regardless of your position, learning how to create and interpret financial statements can empower you to understand your company's inner workings and contribute to its future success. The cash flow statement includes cash made by the business through operations, investment, and financing, the sum of which is called net cash flow. The first section of the cash flow statement covers cash flows from operating activities, or CFO, and includes transactions from all operational business activities. The cash flows from operations section begins with net income, then reconciles all non-cash items to cash items involving operational activities. So, in other words, it is the company's net income, but in a cash version. The second section of the cash flow statement looks at cash flows from investing, or CFI, and is the result of investment gains and losses. This section also includes cash spent on property, plant, and equipment. This section is where analysts look to find changes in capital expenditures, or CapEx. Cash flows from financing, or CFF, is the last section of the cash flow statement. This section provides an overview of cash used in business financing. It measures cash flow between a company and its owners and its creditors, and its source is normally from debt or equity. Analysts use the cash flows from financing section to determine how much money the company has paid out via dividends or share buybacks. It is also useful to help determine how a company raises cash for operational growth. The cash flow statement includes cash generated by the business through operations, investment, and financing, the sum of which is called the net cash flow. We shall now look at the 5 steps to creating a cash flow statement. The 5 steps are: first, determine the starting balance. Second, calculate cash flow from operating activities. Third, calculate cash flow from investing activities. Fourth, calculate cash flow from financing activity. And fifth, determine the ending balance. We shall go through each step in some detail. Step number 1. Determine the starting balance. The first step in preparing a cash flow statement is determining the starting balance of cash and cash equivalents at the beginning of the reporting period. This value can also be found on the income statement of the same accounting period. The starting cash balance is necessary when leveraging the indirect method of calculating cash flow from operating activities. However, the direct method does not require this information. Second, calculate cash flow from operating activities. Once you have your starting balance, you need to calculate cash flow from operating activities. This step is crucial because it reveals how much cash a company generated from its operations. Cash flow from operations are calculated using either the direct or indirect method. Direct method. The direct method of calculating cash flow from operating activities is a straightforward process that involves taking all the cash collections from operations and subtracting all the cash disbursements from operations. This approach lists all the transactions that resulted in cash paid or received during the reporting period. Indirect method. The indirect method of calculating cash flow from operating activities requires you to start with net income from the income statement, see step 1 above, and make adjustments to undo the impact of the accruals made during the reporting period. Some of the most common and consistent adjustments include depreciation and amortization. Both the direct and indirect methods will result in the same number, but the process of calculating cash flow from operations differs. Third, calculate cash flow from investing activities. After calculating cash flows from operating activities, you need to calculate cash flows from investing activities. This section of the cash flow statement details cash flows related to the buying and selling of long-term assets like property, facilities, and equipment. Keep in mind that this section only includes investing activities involving free cash, not debt. Fourth, calculate cash flow from financing activity. The third section of the cash flow statement examines cash inflows and outflows related to financing activities. This includes cash flows from both debt and equity financing, cash flows associated with raising cash, and paying back debts to investors and creditors. When using GAAP, this section also includes dividends paid, which may be included in the operating section when using IFRS standards. Interest paid is included in the operating section under GAAP, but sometimes in the financing section under IFRS as well. Fifth, determine the ending balance. Once cash flows generated from the 3 main types of business activities are accounted for, you can determine the ending balance of cash and cash equivalents at the close of the reporting period. The change in net cash for the period is equal to the sum of cash flows from operating, investing, and financing activities. This value shows the total amount of cash a company gained or lost during the reporting period. A positive net cash flow indicates a company had more cash flowing into it than out of it, while a negative net cash flow indicates it spent more than it earned. Let's watch a short video on cash flow statements courtesy of Investopedia.
Cash flow refers to the movement of cash into or out of an account, a business, or an investment. When cash inflows exceed outflows, this is generally considered to be a sign of good financial health, both for individuals and companies. Ed makes his living running Ed's Carpets. For Ed, cash flow is essential to the survival of his business, as well as his personal finances. Having ample cash on hand ensures that Ed can pay his employees, his creditors, and himself on time, keeping the business afloat. The same goes for Ed. He needs enough cash in his personal bank account to pay for his house, his car, and other personal expenses. Whether we are talking about Ed or his business, there are generally three types of cash flows. 1. Operational cash flows refer to cash received or spent as a result of a company's business activities. For example, a business like Ed's Carpets brings in cash by selling carpets and sends cash out to pay employees and suppliers. Similarly, Ed pays himself a salary, providing cash flow to his personal account. Cash will flow out to pay for his expenses such as food and housing. 2. Investment cash flows refer to cash received or spent through investing activities, basically the purchasing and selling of assets that will help grow the business, or in the case of Ed, assets that will help increase his net worth. 3. Financing cash flows refer to cash received through debt or paid out as debt repayments. For a company, issuing stock, paying down debt, and repurchasing shares would count as part of financing cash flows. For Ed, financing cash flows include any cash coming from loans or other types of debt, as well as payments going to pay down debts. If Ed's business comes up short on cash and is unable to pay its obligations, it will experience a cash flow crunch. To avoid insolvency, Ed will have to arrange some type of financing or bridge loan. A similar situation in Ed's personal accounts would also have disastrous effects that could lead to personal bankruptcy if the cash flow crunch persisted. For this reason, it is important that businesses and individuals manage their cash flow carefully and set aside emergency reserves to cushion any unexpected events.
So, now that we know all about cash flow statements, let's look at the main takeaways. First, the cash flow statement is a vital financial statement that captures all the cash flows in a company. And second, we must always consider all three financial statements in totality in analyzing a company. But remember, cash is always king. Thank you for your time. Until next time then, stay enriched and strong.